Most traders lose money with call options, not because options are bad, but because they trade them without rules. In this video, I'll show you how call options actually work and how to trade them without blowing up your account. A call option gives you the right, not the obligation, to buy 100 shares of a stock at a fixed price before a certain date. You don't need to buy the shares. Your risk is limited to what you paid. Your upside increases as the stock rises. Most beginners lose because they buy weekly or same-day options. Go far out of the money, risk too much per trade, hold losers, and sell winners too early. That is gambling, not trading. Here is how I trade call options with structure. Expiry: 30 to 90 days out strike. At the money or slightly in the money delta. Around 0.5 only liquid. Large cap stocks, no MEMS. No low volume contracts. I never chase green candles. I wait for pullback in an uptrend, price near VWAP or support, RSI cooling off. Volume confirming a bounce, no setup, no trade. This is where most traders fail. Take profit at 50 to 100%, cut losses at 40 to 50%, never average down, never hold through earnings. Unless planned risk management comes first, always. Example, stock pulls back from resistance. I buy a call 60 days out for $200. Before entering, I already know my stop loss, my profit target, my exit plan, no emotions, just execution. I usually trade one contract. Options are leverage, not a shortcut to wealth. If you can't follow rules, options will magnify your mistakes. If this helped you understand call options the right way, like the video and subscribe. I break down real trades, real rules, and real mistakes, so you don't have to.